Good morning, all. I welcome everybody on behalf of Webtel and thank you for joining us on today's webinar. So, I am Nikita Singhal from Webtel and welcoming you to a very important webinar on detailed analysis of Union Budget 2023. So, talking about Webtel, as we all are living in the world of digitalization, where technology is converting each complexity to simplicity, that is why Webtel came into being to make IT a way of life. We are India's leading e-compliance companies known for its compliance management, office management, and HR management solutions. We have Knowledge Academy as well, where you can do all your learnings by opting for self-paced courses, staying in line with the blogs, keeping pace with webinars, etc. Today, we are presenting a webinar on detailed analysis of Union Budget 2023, presented by our renowned speakers, CA Rajiv Khandelwal, CA Tushar Agarwal, CA Gitika Srivastava, and CA Rajat Juneja. So let me introduce you to our speakers of the day. Our first speaker is CA Rajiv Khandelwal. He is a fellow chartered accountant of ICAI and is also a DISA ICAI certified systems auditor. He is also an alumnus of SRCC and has over 3 decades of experience in compliance sector. He has addressed thousands of webinars and seminars on so far on compliances at various forums such as NASSCOM, Institute of Chartered Accountants of India, Institute of Company Secretaries of India, Institute of Cost and Works Accountants of India, and various study circles. So our next speaker is CA Tushar Agarwal. He has more than 10 years of experience in indirect taxes and has worked for more than 8 years with Lakshmi Kumaran and Sridhar attorneys. He was also deployed by the GSTN for GST implementation and has worked closely with the government officials. He has worked extensively with the Government of India GST in designing GST returns, audit, and other formats. Our next speaker is CA Gitika Srivastava, and she is having an experience of nearly 11 years in the field of indirect taxation. Prior to joining Tatvam Advisors, she has worked as an associate director with PwC for 3 years and was associated with Lakshmi Kumaran and Sridharan attorneys for more than 8 years. Her expertise lies in advising clients on laws relating to GST, service tax, excise, customs, including FTP. Our last speaker of the day is CA Rajat Juneja, who is a qualified chartered accountant and a company secretary, a lawyer on a professional front. He is a veteran income tax law expert specializing in international tax laws, transfer pricing laws, and regulatory framework, and has worked with leading consultancy and law firms in India. His experience spreads across railways, construction, telecommunications, IT, and various other sectors. Besides consulting, he regularly represents various clients before quasi-judicial authorities and tribunals, including the ITAT and other appellate tribunals. Mr. Rajat Juneja is a regular speaker and has been delivering lectures at various platforms also. So just a little housekeeping before we get started. If you have any questions during the webinar, please type them into the chat box. We will take the same at the end of the webinar. Now, without further ado, we will turn the time over to our speaker, that is CA Rajiv Agarwal, Rajiv Khandelwal. Sir, please, over to you.
Thank you, Nikita, and welcome to all the participants. And I think it is great that we are organizing this webinar, which is one of the first ones on budget analysis 2020. And we have experts from various fields, income tax and GST, etc. And I'm sure you have a lot of questions, and most of them will be answered by the experts in their deliberations itself. And other than that, if still some queries remain unanswered, we'll try to revert back to them on mail also. And as you're aware, many important changes have taken place, and every time we just think what will come in this budget, because most of the things have been done but the government somehow manages to come out with something or the other, and so there is need for analysis. I wonder when that day will come when there will be no analysis of the budget, because things happen so frequently, so rapidly these days, and the entire year around. Luckily, things have changed though. Initially, if we talk about 10 years ago or 15 years ago, it was like just start buying TVs, refrigerators, etc. Excise duty will increase. All those most these kind of things have been happening during the year itself, and we are not waiting for the budget for that. Just in brief, a few things some of you might be aware, or something you will also emerge. I'll just start the discussion. As you are aware, the new income tax regime will be the default scheme now. So all the and you will have to. Earlier, we had to opt for the new scheme in the case of individuals and HF. Now we will have to opt for the old scheme if we want that. Otherwise, if we are not opting, then it will be the old new scheme itself. And the government is also trying to make it very beneficial, the new scheme. That is why in the old regime, there is no change in the slabs. The initial exemption limit remains at 2.5 lakhs rupees, whereas in the new regime, it has been raised to 3 lakhs. And also, we are getting a higher rebate under the new regime of income up to 7 lakhs, and a rebate amount under Section 87 up to 25,000. All these details will be taken in much greater detail by the respective speakers. And then capping of capital gains. They finally realized that it was for the Aam Aadmi or the common persons. That these exemptions were there. They were not for the super rich. And that is why they have capped 54 and 54 exemption to 10 crore rupees, which is in any case for the normal people, it's a very huge amount. But particularly in cases of super rich, when they get these capital gains and then they invest in properties, etc., residential properties, etc., and other specified assets, then they get the benefit. And government realized that it is not for them, and that is why it has been capped to 10 crore rupees. In TCS, people have been enjoying foreign vacations and everything, and not paying taxes. So government has realized that also. Already TCS has been levied on such tours, etc., other remittances, and that has been enhanced to 20%. Other than education and medical facilities, other things, if you are making foreign remittances, then the TCS rate has been raised to 20%. Again, a significant change. And but these changes, particularly relating to TCS, will happen from 1st of July 2023. So the entire summer vacation is there. You can enjoy the summer vacation in Europe or US, wherever you want, Mauritius, etc. And if you are a little late, then from 1st July, TCS at the rate of 20% will be levied. And even in the case of presumptive income tax scheme, limit has been raised both in the case of professionals and the businessmen. In GST, again, many changes would be there, which will be taken up by the experts, Team Tatvam, and just one I will like to share. No ITC will be allowed on CSR expenditure. Even that is a clarification. And since when it will be applicable, I think Tushar will be taking that in greater detail. With that, I will stop here, and I will request Team Tatvam to take over. Thank you so much.
Thank you, Rajiv ji. We are just sharing the screen. Good morning, friends. In this section, we will be discussing the indirect tax part of the Finance Bill 2023. Firstly, we will cover the GST amendments, and thereafter we will drill down into the customs part. Friends, before we start and discuss the GST amendments, please note that all these amendments which are proposed in Finance Bill 2023, they all have been discussed in GST councils. So whenever we have to analyze these meetings, it is always imperative for us to refer to the GST Council minute book, which is released time and again. So 57th GST Council meeting and 48th GST Council meeting is very important for us to analyze these changes which have been brought under the CGST and the IGST Act. Therefore, whenever we will refer and explain these changes, we will go back and discuss what was the agenda during that 47th and 48th council meeting, and what was the recommendation of the council. The first amendment relates to composition scheme. So before we drill down into the amendment, let's get back into the history of this amendment. Friend, if you see 47th council minute book, page number 12, there they discuss that an unregistered person as well as a composition dealer, they are restricted to supply through e-commerce platform. They are not in a position to enjoy that threshold limit. For unregistered person, the minute book explained that if they supply offline, they get a threshold of 40 lakh rupees. Whereas if they supply through e-commerce operator, they have to take mandatory registration that does not get the benefit of this threshold limit. Similarly, for composition dealer, they are specifically restricted to supply through e-commerce operators. Therefore, there is a disparity for these unregistered people as well as composition dealers to supply offline or online. To mitigate this, they had proposed that unregistered person should be allowed to supply through e-commerce operator and get the benefit of the 40 lakh rupees threshold, as well as they proposed that a composition dealer should also be allowed to supply through e-commerce platform. And hence this amendment is there. However, and this particular, the proposal of the law committee was approved by the GST council. And however, while approving, they specifically said that the system should be robust enough to specifically check that these unregistered person or composition dealers should not be in a position to do an interstate supply, because all these benefit is available only for interstate supply. Now, in this finance bill, they have brought amendment and for the composition dealer only. No amendment has been brought for unregistered persons. Amendment has been brought from composition dealer. Now, a composition dealer who was earlier restricted to supply goods through an electronic commerce operator, that restriction is removed. If we see the striked part, he is not engaged in making any supply of goods or services. So the goods part has been deleted. The restriction is applicable only on supply of services through an electronic platform. A composition dealer now is in a position to supply interstate supplies through economic commerce operator. So the impact of this is a welcome amendment for which composition taxpayer can make interstate supply of goods through ECOs. Similar amendment was proposed for unregistered supplier in 47th council meeting. However, due to lack of preparedness on the GST portal, the same has not been implemented till now. Moving on to the second amendment, and a very important amendment. An amendment has been brought in section 16. There is a specific proviso which provides that if you don't make payment to the supplier within 180 days, then you have to reverse the credit along with interest. So that is a provision. So the way earlier provision was drafted, let me read that provision. Provided further that where a recipient fails to pay to the supplier of goods or services or both, other than the supplies on which tax is payable on reverse charge basis, the amount towards the value of such supply along with tax payable thereon within a period of 180 days from the date of issue of invoice, an amount equal to the ITC availed by the recipient shall be added to his output tax liability along with interest thereon. So the law, the way it was worded, it said that if you don't make payment within 180 days, then your GST ITC amount will be added to your output tax liability and you have to discharge that. And we had rule 37 also for this. So this provision was based on the earlier original return filing concept of GSTR 123. If you recall, when GSTR 123 was introduced, then there was a specific table in GSTR 2 wherein the implementation of this section was through GSTR 2. If you don't make payment within 180 days, there was a specific table in GSTR 2 wherein you have to give the details of those transactions and the same would have been added to your output tax liability. So this was the mechanism which was conceptualized. However, GSTR 123 was never implemented in India, and what was implemented was only GSTR 3B. Accordingly, we used to do all these reversals through 3B. Now what they have done is that they have amended this specific act and specifically written that this amount has to be paid by him along with the interest payable under section 50 in such manner as may be prescribed. If you see on your right hand side, this added to his output tax liability is deleted, and it will be paid by him along with the interest payable under Section 50 in a manner as may be prescribed. Friend, if you recall, from 1st October 2022, the corresponding CGST rule for this section, Rule 37A, has also been amended, wherein they have specifically mentioned that this reversal has to be undertaken through GST 3B. So the rule has got amended, Rule 37 has got amended, wherein they have specifically said that this will not be added to your output tax liability. In the rule, it was said it will be added to your GSTR2, whereas they have amended it from 1st October 2022 to say that the same has to be reversed to GSTR 3B. Now, they have made amendment in the Act also. In the Act, they have deleted this, that this will be updated to your output tax liability. Now, they are simply saying that this has to be paid as per the manner prescribed, and the manner prescribed is Rule 37, which says that it has to be amended. So, it has to be paid through GSTR 3B. See, if we see technically all these changes, whether in the Act or in Rule 37, etc., all these changes which have been proposed, the concept is to align all these changes with the current return filing mechanism, that is GSTR 1 and GSTR 3B. But please note, all these changes are prospective. Rule which got amended, that was prospective from 1st October 2022. This particular section which is getting amended, again, it will be implemented and it will be effective from the date of enactment of the finance bill. It is not a retrospective amendment. So for the past period, in our view, for the past period, because in audits, during investigation, this is one of the common issues being raised by the departmental authorities, that you have not paid payment within 180 days, please reverse the ITC, or you have made payment after 270 days, so we want interest for the interim period, etc. For all your past litigation, there is a good ground to say that the way section was worded and the way rule was drafted prior to these amendments, they were drafted based on the old return filing system of GSTR 123, wherein the section and the rule said that all this has to be paid through GSTR 2 by adding into the output tax liability. Since that mechanism was not implemented in India, accordingly, this proviso read with Rule 37 cannot be deemed to be implemented in India, and hence there is no need for reversal of on account of non-payment to vendors within 180 days. So that's a food for thought. That's a litigative argument which is available for the past period, because the way section and rule was drafted, that was based on the old return filing system, never implemented in India. Now all the anomaly has been corrected. They have redrafted Rule 37. They have made amendment in Section 16 also, specifying that the such amount has to be paid in the manner as may be prescribed. So for the past period, to our mind, this argument is possible that section along with rule was not properly drafted and cannot be implemented in the absence of the machinery provision to implement it. So that's the food for thought. Moving on to another important amendment in Section 17. Friends, Section 17 deals with apportionment of credit. See, basically, if you are engaged in providing taxable supply as well as exempt supply, so to the extent credit pertains to taxable supply, you can avail fully. To the extent it pertains to exempt supply, no credit available, and common credit you have to reverse based on the turnover mechanism. Now, in Section 17, subsection 3, there is an explanation which says that you don't have to, like, for the purpose of this reversals, this value of exempt supply shall not include activities which is specified in Schedule 3. So Schedule 3 specifically covers various activities like high sea sale, etc., wherein no tax is leviable, because it is neither treated as sale of supply of goods nor treated as supply of services. So no output tax is leviable. But there was always a question that since Schedule 3 activities, no tax is leviable, do we have to reverse the credit which pertains to Schedule 3 transaction? There is a specific explanation. No credit reversal required, because for the purpose of this subsection, the expression value of exempt supply shall not include activities specified in Schedule 3. So Schedule 3 transaction, no reversal is required. But there are two exceptions to it. The first exception was already there. That is transaction covered under paragraph 5, basically sale of land, sale of building, etc., wherein that is treated as exempt supply for the purpose of reversal. Another transaction which they have added in this Finance Bill 2023 is, let me read, the value of such supplies or transactions as may be prescribed in respect of clause A of paragraph 8 of the said schedule. So they specifically said that value of such transactions or activities which are prescribed in terms of paragraph 8A of the said schedule, that will be treated as exempt supply for the purpose of reversal. when we talk about paragraph 8A, paragraph 8A deals with those transactions which are from bonded warehouse. So whenever like we sell goods from bonded warehouse, there is no GST on it. So this is the transaction which is specified under paragraph 8A. See, if you actually look at the wordings of this amendment, this is very important. It says value of such activities or transactions as may be prescribed in respect of clause A. So paragraph 8A may cover various types of transactions. There can be various types of transaction of sale from bonded warehouse. All those transactions will not be treated as exempt supply. It is only those transactions which they will specify that this is the activity, this is the transaction that will be treated, which is covered under paragraph 8A, that will be the treated as exempt supply for the purpose of reversal. And what is that transaction? For which we will go back to the reason behind this amendment. If this is the extract from the minute book of 47th GST Council meeting at page number 24. Friends, duty-free shops. There was a discussion on duty-free shops. Duty-free shops supplies goods to the international passenger as well as arrival passengers. For the international passengers, the GST Council recommended that these should be treated as zero-rated supply, and accordingly, there will be no need for reversal of credit, and refund will be available. That is for supply by duty-free shop to international passenger. Similarly, they have recommended for arrival passenger. If we see the last bullet, last two bullets, what the law committee has recommended. For future, there is a need. Let me read. There is a need to exclude refund in respect of ITC on input services pertaining to duty-free shops at arrival terminal by amending explanation to subsection 3 of section 17 by including certain transactions under paragraph 8A. So 8A may cover various kinds of transactions. From sale of bonded warehouse, multiple transactions are covered. Only these two transactions are the intention. What they say, the law committee recommends to amend subsection 3 of section 17 of the CGST Act by substituting the existing explanation with the explanation proposed in the agenda. Post amendment in subsection 3 of section 17, the supplies, very important, the supplies from duty-free shop at arrival terminal to the incoming passenger to be prescribed to the rules so that the value of sub-supply are not excluded for calculation of value of exempt supply for reversal of ITC. So it seems that this amendment is brought only for the specific transaction of sale by duty-free shops at arrival terminal to the incoming passenger, and it will not apply to sale of from bonded warehouse and for all other types of transactions. It is limited to sale by duty-free shops. So we wait for the rules to be prescribed. This is only an enabling section, which they have enabling amendment, which they have done under section 17. Another very important judgment amendment under section 17. One of the most hot topic, credit on expenditure incurred for CSR activity. There is a series of dispute which is going on from last couple of years, whether ITC is available in respect of goods and services procured for undertaking CSR responsibility. So one view which we always used to take, that CSR is something which is obligatory under section 135 of the Companies Act. I have to mandatory undertake this CSR activity, which is mandatory as per section 135 of the Companies Act. If I am doing business, I have to follow section 135 of the Companies Act. So any credit is allowed for any expenditure which is in the course of your business. And the definition is also very wide. So we always used to argue that this expenditure of CSR, which we are incurring under section 135, is a mandatory expenditure, and it should be treated as an expenditure in furtherance of course of business, because I have to mandatory undertake. Without this, I won't be in a position to carry on my business. So it is an expenditure incurred in the course of business, and I should be eligible to take the credit until and unless I am specifically excluded under section 17.5 negative list. There are series of judgments also. Various advanced rulings have come in tribunal like SL Propex. Favorable judgments also have come, but department at ground level have always denied the benefit of credit on CSR activities. Now they have made it amply clear for the future period. What they have said, that they have inserted clause 5A under section 17.5. It read as goods or services or both received by a taxable person which are used or intended to be used for activities relating to his obligation under CSR referred to in section 135 of the Companies Act. I think that the ITC has been now disallowed on goods and services used for the purpose of CSR activity. The law is amply clear, but most important point to be noted is that this amendment again is prospective and it is not retrospective. This is not retrospective. It is not a kind of a retrospective explanation, etc., which is added. This is a condition which is imposed for the first time. This is the restriction which is imposed for the first time. And now it clearly says that grade will not be available, and this will be effective from the date of enactment of the finance bill. But what about the past period? To my mind, for the past period, we can still contend that ITC is available. In fact, this amendment being prospective gives us more grounds to contend that the intention to restrict has come from today and not earlier. Earlier, all these expenditure were in the course of business only, and hence credit should be eligible. For the past period, we can still contend, we can still fight, but post this amendment, credit will not be eligible. And important friends, whenever we say that this is a prospective amendment, this is not a retrospective amendment, etc. Whenever you read finance bill, now legislature in its wisdom has decided which amendment has to be made prospective, which has to be made retrospective. Even in this finance bill 2023, the next amendment which we will discuss, this is a retrospective amendment from 1st July 2017. So wherever the intent and the intent of the legislature was to make certain amendment retrospective, they have done it. Like for this particular next amendment which we will discuss. So this is a prospective amendment only, and accordingly for past period it cannot be applied. This is a very important amendment which has come up. Before we discuss the implication of this amendment, let me give you a case study, a live example, and what was the current situation, which was happening. Say there is a company which is dealing only in exempted goods. Now they receive a GTA service. Since they are dealing in exempted goods, they were not required to take registration. But since they receive an GTA services, the issue was that for GTA services, since RCM is applicable, so for payment of this RCM, are they compulsory required to take registration even though they are dealing in exempted product only? Section 22, 23, 24 are the relevant sections for the purpose of this case study. Section 22 deals with registration. It says that a taxable person whose threshold is beyond a certain limit, he has to take registration. That is section 22. Section 23 specifically says persons not liable for registration, and it says a person who is dealing exclusively in exempted goods, etc., he is not required to take registration. And then we had section 24. 24 said, the way 24 is drafted, it says 24 says notwithstanding anything contained in section 22 only. It does not talk about 23. It says notwithstanding anything contained in section 22, a person is not required to take registration. A person is compulsory required to undertake registration if he is doing various activities, say making interstate supply or availing RCM services, etc. So for RCM under section 24, there is a compulsory registration, as section 24 only overrides section 22. Therefore, all those people who were engaged exclusively in exempt supplies, they were required to take registration for RCM related activities, say they are availing import or service, or they are availing GTA services, etc. Now they have made amendment in section 23, and what they have done, they have added the first line basically, notwithstanding anything to the contrary contained in subsection 1 of section 22 or section 24. Now section 23 has given an overriding effect over section 22(1) and section 24. Now section 23 says, notwithstanding whatever is contained in section 22 or 24, if a person is dealing in exempted goods and services, he is not required to take registration. So today, and this is a retrospective amendment. So if you are say manufacturer of electricity, you supply power, exempted product, no registration required. Even if you are availing RCM services on which RCM is applicable, like GTA, etc. So this is a very important amendment. And it will give relief to various people and taxpayers who are exclusively dealing in exempted services, but they were required to take registration. I know various schools, etc., exempted services, but required to take registration because of some RCM liability on account of GTA service, sponsorship service, etc. This is a big relief to the entire industry. A very welcome amendment. Now, with this, I will hand over the session to Gitika for taking the future amendment. Other amendments.
Thank you, Tushar. You have very, aptly touched upon all the major amendments which are applicable to industry at large. Some may be very industry specific, some may be general. From here, I'll take forward with the other amendments which have been brought in the GST Act, and I'll also touch upon two major amendments which have been made in the IGST Act. To start with the next amendment, there has been, we have been filing monthly returns, your annual returns and your TCS returns. There has been no restriction as on date on the upper limit of filing these returns. Now, what the government has decided is that we cannot let people endlessly file the returns. So they have put in a cutoff period of 3 years. This amendment has been brought in specifically 4 sections, section 37, 39, 44, and 52, which covers your normal GSTR 1 return outward supply, GSTR 3B, where you take the ITCs and you pay the taxes, then your annual return and the TCS returns. Similar amendment has not come with respect to the TDS returns or any other kind of other returns or a composition dealer sort of a returns. So only these 4 returns, they have restricted a cutoff date beyond which any taxpayer will not be allowed to file the returns. Yes, a doubt would come that if they don't allow us to file the return and if someone wants to pay the taxes, I believe they'll bring up some mechanism to make the payment of taxes in case there is any non-payment. But a particular return which is covered under these specific sections, these will not be allowed to be filed. This appears only to put up a cutoff date because there were endless filing of returns. People are still, filing returns with respect to 2017-18. Just to, curtail this kind of a practice, this particular amendment has been brought in. Then there is some, cosmetic change, I would say hygiene change that have been made in the refund provision, because refund provision was worded in a way where they'll be providing the provisional refunds, and there was some language relating to provisionally accepted ITC. We all know with effect from January 2022, the concept of provisional ITC has been done away. I think this is nothing but just to, streamline all the amendment with respect to the corresponding amendments which have been made in the law. Just a hygiene check on the language of the law. Nothing changes as of now because the refund provision with respect to any activity which was falling under section 54 continues to remain the same. Again, with respect to calculation of interest on delayed refunds, initially the language was only restricted in a manner that the refund will be provided from the date of receipt of application under the said subsection till the date of refund of such time. But there was a lot of anomaly that how this has to be calculated. So now, because of a lot of disputes, we know that it's not a normal situation that any time a refund can be simply granted. It may go into appeal, it may go into dispute. So there was I would say, misunderstanding or a lack of understanding in the concept of that how do we calculate the period of the refund, delay of giving the refund if certain these kind of events happen. In such a situation, what they have done is that they have changed the wording of this language to make it more like an enabling provision, wherein specific rules will be brought in to prescribe how this delay of the period of delay has to be calculated for calculating the interest. The rules which will prescribe or the manner that has to be prescribed is yet to be notified by the government. But the section has been amended so as to say that tomorrow, if they bring in any rule, we go to the court saying that you never have the power to make such rules. Why are you making such provisions under the delegated legislation? Just to protect themselves from any future litigation, the language of section 56 has been worded just to allow that any procedure or any mechanism which has to be prescribed will be prescribed in the in the rules or in any other form which the government thinks it to be. Now, this is a very important amendment for the e-commerce operators. Till date, the e-commerce operators were only required to do certain compliances, and any general penalty or any non-compliances only on part of their transaction or their non-compliances was being plucked by the current provisions of the law. Now, once section 122 has been amended to impose penalties on the e-commerce operators in these 3 specific transactions. Number 1, if they are allowing any supply of goods and services by any unregistered person other than those who have been exempted. Please note, section 24 specifically requires every person who's dealing on the e-commerce portal to take a registration. So now the onus has been passed on to the e-commerce operator to check that whether if the person is coming on their portal, if he's registered or not, and if he's not registered, then whether he has been given any specific exemption, because 24 doesn't give any relief to any person who can come on the portal without taking registration. Like we discussed in the previous session, there was a discussion in the 47th council meeting that they want to give benefit both to the unregistered persons as well as the composition taxpayers. But the provision has been amended only with respect to the composition taxpayers and not with respect to unregistered person. So unless until a specific exemption is brought in with respect to these people, the e-commerce portal, in case they allow anyone to do any transaction without having a registration, they will be penalized for allowing such transactions on their portal. Next, if they allow any interstate supply by any person who is not eligible to make an interstate supply, the first thing that comes to my mind is the composition dealers. I don't think there is any other specific restriction as of now, but we don't know if it comes over a period of time. So if the e-commerce operator is allowing any person, because it's a new amendment that has come for the composition dealer, therefore this kind of a restriction is also pushed on the e-commerce operator to ensure that they don't allow these people to do interstate supply in the garb of doing transaction in the e-commerce on the e-commerce platform. Again, huge onus passed on to the e-commerce operator to ensure that if I am dealing with a composition dealer who is coming on my portal, he should not be allowed to make any interstate supply. Lastly, if they fail to furnish any information, any details in the section 52, which is the TCS returns that they are supposed to file with respect to the supplies which are made by them, again, the responsibility is on the e-commerce operator to ensure that the correct information has been passed on. And if they don't do it, it has been penalized with the penalty of 10,000 or an amount equivalent to tax, which is to be paid in case any tax is payable other than for the composition dealer. So all in all, if you see, a huge onus has been placed on the e-commerce operator, because as on date, what they were required to do was only to ensure that the information that is being or any transaction that is being done on their portal, they were supposed to only collect the TCS amount wherever it was applicable and deposit it to the government. Now, they also have to ensure that all those people who are coming on their portal are the ones who are eligible to do this transaction, are the ones who are eligible, are doing eligible transaction. So this kind of a penal provision being imposed on the e-commerce operator would really warrant them to get into the due diligence, check the whereabouts. While they do it, the KYCs, etc. are done, but it's not going to be a one-time activity. It's a continuous thing. Someone may come on board, do a transaction which is not allowed to be done, like a composition dealer doing interstate transaction. So continuous check has to be made. Could be done through upgrading the systems, having validation checks in their systems. It's all through the internet platform. The e-commerce platform is operated through internet, various applications. So that kind of an upgrading and checking and validation checks would be required by the e-commerce operator, so as to safeguard themselves for any penalty which may be imposed on them because of these non-compliances. This is, I think, a minor relief, I would say, given to the taxpayers under Section 132, a very draconian provision which has been implemented in the law and is being used by the tax officers also, left, right, center, just to threaten the people, the taxpayers. The punishment for the certain offenses. So 3 offenses have been taken out from the prosecution provision. One is if anyone is obstructing or preventing any officer in discharging of any duty, if he is tampering or destroying any material, or if he fails to supply any information until there is a clear-cut information that the information that is being hidden is of, or is being supplied is of a malified nature, or the intent is malified. Otherwise, in genuine cases where these kind of activities are taking place, the government has given relief to the taxpayers to decriminalize them, meaning thereby if someone is charged with these kind of offenses, they will not be prosecuted. Another benefit that has been given for the in the field of decriminalization is that the threshold has been increased from 1 crore to 2 crores in case of any of the offenses which are falling under 132. except where the offense is in the nature of passing off the credit through fake invoicing and making supplies without invoicing. Only there the threshold limit would still be 1 crore. Otherwise, the threshold, the bare minimum offense, the value of the tax has to be 2 crore for prosecuting any taxpayer for any offenses which has been pushed under the section 132. Then there are certain changes made in the compounding of offenses. Some offenses have been deleted, added. I'll not take much of your time on this because this is rarely used provision. Just to have a touch upon that, few offenses that were allowed to be compounded are no more allowed now. And the slab, the tax, compounding tax that was allowed to be paid, has the value has been reduced from 50% to 150% range. The range has been reduced to 25% to 100% of the tax amount. This is like someone is, if he's going to compound for an offense, this was the amount that he could have, minimum and the maximum amount that he would have paid and get out of the criminal proceedings. Section 158A, this has been inserted. Again, this was an issue in the council meeting, the 47th council meeting, that there has been a lot of information sharing between various departments. So just to safeguard themselves from being this kind of an activity being challenged before any court, there has been a proper procedure which has been prescribed in the section has been enabled, that the tax officers can share the information which is coming on the common portal, which can be shared with the other tax authorities or various other authorities as per the procedure that has been prescribed. This is more from the department's perspective, maybe not directly impacting the taxpayers. Schedule 3 activities, these were all added, from the retrospective effect. Para 7, where any high C sales have been taking place, the warehouse goods, like we discussed about the duty-free supplies and any kind of a high C sale transaction which is happening. These activities have been now made, amendment has been made with retrospective effect. Because there was a lag, because when this was amended, it came from the 2019, and there was a dispute regarding the previous period, that whether it should be the benefit should be given, because the dispute was mainly with respect to the ITCs. So the department was still disputing that the amendment is prospective, and for the previous period the benefit should not be given. Now this has been brought in retrospectively. Therefore, any of these supplies will continue will be considered as falling under Schedule 3 transactions from the very first day, and any implications arising out of that, for example, ITC, etc., will also be considered to be having impact with the retrospective effect, that is 1st July 2017. Now, 2 major amendments in the IGST Act which have been made, and again, 2 of them are mainly to clarify or maybe to simplify the procedure, and the third one I would say is basically with respect to the freight forwarding industry. The first 2 amendment pertains to the online information sharing services, the OIDR services, which we say. Just to set the context, under the current law, before this amendment, there is a service which is in the nature of the online information database access and retrieval services. In general, these services, if they are being provided from a person located outside India to a person located in India, if the recipient was a registered person, they were clearly getting covered under the RCM mechanism, no doubt about it. The issue that started coming up was with respect to unregistered people when they are using it for personal use. So there was a lot of online gaming apps, online, content access, online videos that were being downloaded. So here the government identified in the initial period that this is the area which might escape the taxation, because when an OIDR supplier who is sitting outside India is providing service to an unregistered person, this will never get plugged under the RCM, because RCM is only applicable to the registered person, and any individual or an unregistered person who is not doing business is not required to take any registration for the purpose of paying RCM. So the transactions or the supplies which were made by these OIDR to these unregistered category, which initially included the government, local authorities, governmental authorities, individuals, or any person who was not registered or required to register. And if these services were used for any activity other than business and commerce, like for personal uses, then these OIDR who were sitting outside India were made liable to pay taxes. There was a specific section 14 in IGST Act, which prescribed the manner how the taxes have to be paid, whether through the intermediary or through the agent or any representative that has to be made liable in India in respect of these foreign suppliers. Now, there was a lot of confusion which was going on, that whom do you call as an unregistered person? How do you decide whether the service which is being used is for business purpose or other than business purpose? So now, to rest all the dispute and the confusion with respect to this particular definition, the law has amended the definition in plain wordings to say that a non-taxable online recipient means any unregistered person receiving online information and database access or retrieval services located in taxable territory. So what we have done is simply making OIDR suppliers, when they are providing services to non-taxable online recipient, making it taxable. And these non-taxable online recipients will be all unregistered person, whether or not they are in the form of government. While for an unregistered person, they are specifically included the government also, if they are only taking registration for the purpose of TDR. There could be government authorities who have taken registration for their outward supplies, but if any government or any local authority who have taken registration only for the purpose of deducting TDS, they have also been categorized under the unregistered recipient category, meaning thereby, if any of these persons are taking services from an OIDR who's sitting outside India, it becomes the responsibility of the supplier to come over here or appoint someone over here to make the payment of the taxes with respect to these services, irrespective of the fact whether these services are used for the personal nature or for the business. I would say cleaning the slate, because earlier an OIDR sitting outside India, how would he determine that whatever I'm supplying, whether it is used for business purpose or not? He can't, keep on taking all the information. At best, what he can do is he can get the information, do some KYC, some basic search. But ultimate usage is not in his control. So again, people were escaping that we gave a content. How do we know that it is a business content or not? This is an unregistered person. So we assume that he is not registered. He is not doing any business. Doing away with all this confusion. Now, any OIDR sitting outside India, if they are providing services to any non-taxable, unregistered person, whether or not such services are used for business purposes or for personal purpose, tax has to be paid by such OIDR in the manner prescribed under Section 14. Another change that they have brought in the definition of OIDR itself is very conveniently deleting certain expression which helped the taxpayers to in a way to contend or protect themselves from any OIDR taxes. The terms essential, if I read the definition, online information database access and retrieval services means services whose delivery is mediated by information technology over the internet or an electronic network, and the nature of which renders their supply essentially automated and involving minimum human intervention and impossible to ensure the absence of IT include so-and-so services. So these expressions, essentially automated and involving minimal human intervention, this has been deleted. Now what happens? This will expand the scope of the OIDR services, which as on date, anyone would have argued that if any service which is being delivered through an online medium, if it is having some substantial human intervention, classic example is of doing online coaching trainings. As on date, we were able to safeguard these transactions from falling under OIDR, because when anyone is doing an online coaching or satellite classes are happening, a tutor is on the other side, then this will not qualify as a minimal human intervention. This was always a substantial human intervention which was there. A tutor is teaching, he is delivering lectures from an online medium. Now, with the deletion of these words, these type of services might get classified under OIDR, again calling for the tax implications depending upon the recipient's status. If it's a registered person, say for example, any organization has taken an online management training, coaching or a training services from the foreign supplier. So as on date, it would have been out of OIDR services, and there would have been a sufficient argument to say that the company was not required to pay any tax under RCM under OIDR category, while in general coaching and services would have fallen under the RCM. And from the OIDR perspective, they would, if they were doing it for any unregistered person, they would have simply said that this is not falling under the OIDR category, therefore no one is required to pay the taxes. With deletion of these clauses, huge impact on this industry, that whether or not the services are automated, whether or not it involves any kind of a human intervention, any service which is coming over the online medium will fall under OIDR, and the implications would be followed. Again, the amendments are prospective, so anything which is prior to the enactment of this particular clause of the bill would still fall under the same category as we have been interpreting in the current set of the provisions of the law. Now, this is another major amendment for the freight industry and also for the people who are dealing in the export of the good. Earlier, Section 12, which was applicable when both the supplier and recipients were within India, but they were taking the transportation services and the goods were going outside India. So this service, in this particular case, the place of supply of this service in general, while the general rule was it should be the location of the registered person, the same was made as a destination based place of supply if the goods were going outside India. We would have seen that in December, we got some circular also with respect to the clarification. There was a lot of dispute regarding the ITC, because when I am exporting any goods, the destination of goods will be outside India. So as a supplier, the transporter would have charged IGST. If a recipient is a registered recipient company, and they are making export, it's their goods which is being exported. So the doubt was always coming with respect to the IGST which was being charged by these transporters. Credit matching the credits, these transactions were not coming under the eligible category in 2B. Therefore, in such a situation, what was happening? The taxpayers were being denied the credits. The department was raising disputes on these credits. And of course, the taxpayers were also apprehensive of taking such credit, which was not coming under the eligible category in 2B. And of course, if they take it, leading to the disputes by the department. Therefore, we got a circular in December clarifying that in such a situation, even if there is an IGST, the recipients, the registered recipients would be entitled to take the credits. Now, in order to do away with the complete confusion, the law itself has been amended. The proviso has been deleted. Straight away, if you are providing any transportation services to any registered person, whether or not the goods are in India or outside India, and your recipient is in India, it will be the location of the registered person. Nothing, just to allow the free flow of the credits to the taxpayers, and aligning it with the clarification given by the circular. Now, quickly touching upon on the customs changes, because changes are widely with respect to the rate, and it will be difficult to take up all the rate changes, and yes, of course, may not be relevant for everyone. So I'll just touch upon the major part of the changes that has happened under the customs law. One change has happened under section 25(4)(a). This is with respect to a sunset clause, I would say, or an expiry period which was given with respect to conditional exemptions. Certain notifications has been excluded from this expiry clause, and they can continue with the respective notification dates. Therefore, just a relief to these particular kind of a transactions. Lot of rate rationalization has happened. Again, promoting to the Make in India scheme that has always been the thought process of the PM of the country, that we want to promote the manufacturing in India. Therefore, A lot of duties have been increased on the products which were being imported. Relaxations have been given with respect to raw materials and the parts which will be required for making, so for example, mobile phones, television, etc. Certain changes in respect of the exemption notification, exemptions have been, the period of exemption has been extended from 1 year to 5 years, etc. So without getting into very specific, just to give you a glimpse that someone who is dealing in certain import and export goods need to just rush through these notifications to figure out that if any of the rate has been changed with respect to their goods. Major changes happening in the precious metal sector, the gold, silver rates being increased, chemical, electronic goods, again, somewhere it's a reduction, somewhere it's an increase in rate, automobile sector, etc., have been given certain exemption to promote the e-vehicles, and of course, various capital goods for generating the for making of the batteries, etc., for the e-vehicle segment. So, not getting into the specific, another benefit that has been given to the CNG sector, the excise exemption has been given in case of blended compressed natural gas, very relevant to the power sector. You may look into the specific notifications and figure out that any of your goods are falling under any of these notifications where any exemption has been granted, withdrawn, or any rate change has happened. With this, I would want to conclude the session with respect to IDT. Thank you so much.
Thank you. Hello. Thank you, Kritika ma'am. Over to you, Rajat sir. Please say.
Thank you, Team Webtel. Thanks, Gitika and Tushar, for such a beautiful session. It's always a fascination to hear both of you and having detailed insights on the GST as well as the customs law. Good morning, all the viewers, for staying tuned for such a long time. This union budget, perhaps the last full budget just before the next year general elections, has sought to build the roadmap that was laid by the previous budgets. With a larger focus, perhaps, was given on the inclusive development to foster the growth, the job creation, and at the same time, while keeping the macroeconomy stable and with a sustainable growth-oriented mode at the same time. There was one key term that was mentioned by the Honorable Finance Minister in the budget speech, wherein the term Saptarishi was used. And this term specified that there are 7 key areas where the development reforms are being made through this budget. One was inclusive development. 2 was reaching the last mile. 3, infrastructure and investment. 4th, unleashing the potential. 5th, green growth. 6th, youth power, and 7th, financial sector. So primarily these 7 were the key areas where the focus of this budget has been largely for the time being. At the same time, there was impetus that the Ministry of Finance is trying to give to the new age technologies that are there, whether it is through promotion of artificial intelligence or robotics, or at the same time, laying significant emphasis on the capital outlay. I was told that the capital outlay to GDP ratio is nearly 4.5% this time, which is a very good number. At the same time, the tax to GDP ratio is also, getting nearly 10%. That's a very significant, growth, because in the sense, never in the history has happened that your tax to GDP ratio has gone to that percentage. So that's again a very good move. At the same time, this being the last full budget, as I said, definitely there was a wish list for the common man. And yes, with the new tax regime that they have introduced, there would be certain tax savings for the common man as well. At the same time, for even the high net worth individuals, because of the reduction in the surcharges there, So there would be certain tax savings that even they would also be, at the end of the day doing. Apart from that, on an international tax front, I was quite surprised, and most of the international tax professionals would be, because there was no echo of the globe rules with the global minimum tax rate being, that was suggested by the Pillar 2 recommendations. There was no echo of all that in the budget. Maybe primarily the reason I feel is that India might be having a wait and watch policy on that. And that too, at the time when India just held a G20 presidential meeting. So there is a lot that even the non-residents these days are expecting from India. And the reasons primarily are that India has the biggest consumer market base. And with the sentiments going against the European continent for the fact that war running between Russia and Ukraine, anti-Chinese sentiments since the pre-COVID time. So all these things are there in the mind of non-resident investors, and they were looking at India in a very, in a very keen and in very positive manner, because there was huge investment that I am told that is coming around the way. But be that as it may, we have the budget, and as always, it will have its own set of objectives and priorities. Without taking much of your time on all these things, let me get into the amendments that were proposed in the income tax law. I will start with the personal taxation front. Uh, so there was amendment that was proposed in section 115 BAC, where the slab rates have been rationalized. So from 0 to 3 lakhs, you don't have to pay any tax, 0% tax rate. From 3 to 6 lakhs, the rate of tax is 5%. From 6 to 9 lakhs, it is 10%. From 9 to 12 lakhs, it is 15%. And from 12 to 15, it is 20%. And thereafter, it is 30%. Interesting aspect to note is that this new tax regime is a default tax regime, like the earlier last time when they introduced. So there was some Form 10 IC, I was told you will have to fill and you will have to opt for the new scheme. Now they have made the new scheme as in default scheme. And if you want to opt for an old scheme, then you will have to opt for it by way of filing a form that would be prescribed subsequently. So in a sense, now if you opt for a new tax regime and you have a tax income up to 7 lakhs, then there would be no tax. At the same time, as I said, the income of the HNIs also will be reduced from the earlier maximum marginal rate, which was nearly 42.7%. It has gone significantly down to 39% effectively. That being, there was another amendment that was proposed in context of the retiring non-governmental employees, in context of the tax exemption limit, in context of leave encashment that has been raised to now 25 lakhs. So there was a few more things on the personal taxation front, but I am leaving all that for the time being, and I am covering the major amendments. Now I am coming to the amendments that were made in Section 10. So the exemption of income, which was there earlier for the news agencies, has now been withdrawn under Section 1022B. Now even the news agencies will have to pay taxes. So exemption has been withdrawn. The second amendment was in context of Section 1046A, wherein a specific section has been introduced, which says that any income which arises to a body or authority or a board or trust, not being a company, which has been established by the Central Act or a State Act with one or more of the following purposes, which could be in dealing, and satisfying the need of the housing accommodation, planning, development, or improvement of cities, towns, and villages, regulating the development or activity for the benefit of general public, regulating any matter for the benefit of general public arising out of the object for which it has been created. So all that has now been provided that would be exempt under Section 1046A. This perhaps is an outcome of the recent Supreme Court judgment in Ahmedabad Development Authority, wherein there was the tax that the Supreme Court had said would be levied on these authorities. So to overturn that judgment, this amendment providing the exemption to these authorities have been introduced. Then there was another amendment in section 10AA, wherein the deduction under section 10AA has been now clarified that would be claimed only if you have filed your ITR within the due date of filing of your return. Otherwise, it won't be applicable. So there was an anomaly in the sense that section 143(1)(a), which is a mechanism of processing your ITRs, used to mention this aspect, wherein if you hadn't filed your return within time, 143(1)(a) notice would be coming to you even for a 10AA deduction. But if you look at section 10AA deduction, then this specific proviso was not there. So there was an anomaly in the sense that section 10AA is a substantive provision, whereas section 143(1)(a) is a procedural provision. So if you have something mentioned in the procedural provision but not in the substantive provision, then it was as good as it would have not been given effect to, because without a substantive provision, the procedural provisions will always fail. This is the legal settled principle. The second amendment again was to overrule certain ITAT judgments, again in context of section 10AA, which said that you will get the deduction under section 10AA provided that you will bring the convertible foreign exchange money within a period of 6 months from the end of the previous year. So earlier this condition was not there, and there were many ITAT judgments which have held that because this condition is not there, so therefore you may not, the department cannot, constrain granting of such benefit to the SSCs. But now they have clarified that even for 10AA benefits, one has to bring the convertible foreign exchange money back in India within a period of 6 months. So these were the couple of amendments under section 10AA. Then I moved to the amendments which were made under the chapter PGBP. And the first and the one which is most significant, I would be dealing a bit detailed into this amendment, is an amendment in section 28 subclause 4. And at the same time, it has a linkage with section 194R, which is a withholding tax provision for the income falling under section 28(4). So if you look at the pink book, the memorandum says that we are making this clarificatory amendment. And while doing so, we are referring to a circular number 20D of 7 July 1964, wherein the benefit or a perquisite, which is paid or payable, whether in cash or in kind, or partly in cash or partly in kind, were also covered. That was already mentioned in that circular. But despite that, in a recent judgment by Supreme Court, Honorable Supreme Court in Mahindra and Mahindra, wherein the case which was involved was the waiver of loan, and to whether the fact that the loan waiver will be taxed in the hands of the recipient or not under section 28(4). So Honorable Supreme Court held that the expression whether convertible into money or not in section 28(4) would mean that money is not capable of being converted. Therefore, money/cash is not covered by the section 28(4). And on the basis of this ground, Supreme Court in Mahindra and Mahindra said that loan waiver is not taxable in the hands of the recipients. Now, with this amendment, very interesting thing has happened, and that is that they have provided now two clauses. Clause A covers the same expression which is already existing, the expression whether convertible into money or not. Clause B now covers whether paid in cash or in kind, or partly paid in cash or in kind. So the effect of this amendment is very, very dreadful, in the sense that now what I foresee that all the loan waivers, interestingly, would be taxed in the hands of the person who has taken a loan. And Section 194R has also been amended to say that the banking institutions or the NBFCs who have been granting these loans to these assessees and subsequently waiving it off would have to deduct tax under Section 194R, because Section 194R also echoes the same change. One important point here to note is that there was a recent circular, I think circular dated 13 September 2022, and the circular number was 18, if I'm not wrong. In that circular, they have specifically exempted banks and NBFCs from deducting taxes on an amount which is paid in cash or in kind, or partly paid in cash or in kind.
Hello,
So,
Rajesh sir. Sorry for disruption. Are you sharing any presentation?
no, I don't have a presentation to share. I am only just going through the memo.
Okay. So your Zoom presentation screen is sharing. So can you please stop it, or you share what you want to present for the audience,
I don't have anything to share.
so that you can stop presentation over the top at the red. There is a red button for it.
There is a, let me see. I cannot change it from here. I'm sorry.
Yeah. Okay, sir, you continue. I will stop it.
I am going through the memorandum only. I have no presentation as of now. This budget somehow has been a cakewalk, except for 2-3 judgments where I will be taking your time. One is this 28.4, but I haven't prepared any presentation because.
Okay, not an issue, sir. You can continue yours.
Okay.
Okay.
Right. So basically, now I was on this judgment, which is Section 28.4, and I was mentioning that it would have a very, dreadful impact in the sense that now, to the best of my understanding, the loan waivers would be taxed in the hands of the person who has taken a loan and which has been subsequently waived by the banking institutions and NBFCs. But interestingly, the banking companies and the NBFCs can take a view that Section 194R will not be applicable on them, relying on the circular number 18 dated 13 September. Right. So, and rightly so, because there was a representation made by banking companies and NBFCs in the sense that they made a point that, say, for instance, if we are granting a rupee 100 loan to a person, say X, and subsequently we are waiving that loan. Now, if you ask us to deposit tax on that waiver of loan, then that would be like further burdening, ourselves. We will have to gross up that amount and we will have to pay further, tax on it. That would shell out further money from our pockets. And that too, when we have already suffered a loss in the form of waiver of loan. So, accepting all those representations, Section 194R, was relaxed by way of that circular, and now the banking companies and NBFCs are exempted from deducting TDS under Section 194R. But having said that, the waiver of loans in the hands of the SSE, in whom favor the loan has been waived, now they will have to pay tax. So, in a sense, it is an overturning of a Supreme Court judgment in Mahindra and Mahindra. So it's a very, very important judgment, and it has less been talked about. It is something which is a hidden weapon in this bill, which will have a very huge ramification going forward. So this was one amendment that I was talking about, Section 28.4. Second amendment is again in context of Section 35D, wherein there was a relaxation, that has been given while you seek to amortize preliminary expenses. So earlier there was, a concern which has to be approved by the board. Now that condition has been removed, Now you will simply have to furnish a statement containing all the particulars of expenditure that you have done under section 35D, subsection 2, subclause A. And these expenditure are in the nature of like, project feasibility report and other, groundworking that you do before you set up your business. So all these expenditure can now be claimed by the assessee itself by furnishing of a simple statement containing the particulars of the entire expenditure that you've incurred. So it's in a sense, it's a, an amendment to ease the claim of amortization under section 35D. Another amendment which has been talked about a lot since past few hours is the relaxation, or probably I would term it as the rationalization of section 44AD and section 44ADA. So under section 44AD, the current limit was 2 crores. Now that limit has been extended to rupees 3 crores. And under section 44ADA for professionals, this limit was 50 lakhs. There was a representation made by professionals, and now this limit has been extended to rupees 75 lakhs. So this is nothing but a rationalization of the limits. Then we move to another amendment, which perhaps is in a sense a boost to MSME sector, in the sense that the assessees would now be allowed to claim the expenditure of the payments that are due towards the MSME enterprises only on actual payment basis. So unless you make payment to these MSME enterprises, you won't be allowed deduction under section 43B. So this again will definitely ensure that they have a good amount of cash flow situation available with them, and there is no sort of a situation of a cash blockage, because these MSME sectors are the upcoming sectors, and for them maintaining liquidity, having a good cash liquidity ratio is very important. So this small tinkering in a form in an amendment would definitely boost these MSMEs. Now I move to some of the amendments that have been sort of proposed in capital gains chapter. There was a big buzz that the entire capital gains scheme is going to be revamped. There would be a more simplification in computation provisions and all. But all that has been not done. Probably one of the reason could be that this was the last budget before the general election, so the government wanted to play safe. So a few amendments, very simple. One of them is obviously in context of providing limits as far as section 54, section 54F related deductions are concerned. They have clarified that now upon reinvestment, this cap of exemption is limited to rupees 10 crores. So this might not impact small and middlemen. Maybe this would impact HNIs. But having said that, if they are HNIs, they ought to pay higher taxes as well. So it is not going to make much impact for a common man. The second amendment, which again is a good amendment, and it also had one small loophole connected here, which the people can definitely look into, is this amendment that I'm talking about is the insertion of section 50AA, and this perhaps is relating to the taxation of capital gains for the capital asset in the nature of market linked debentures. So earlier the market linked debentures were being taxed at a lesser rate. The rate of tax was 10%, and the taxability, depending upon the period of holding, could be either long term or short term. But now they have brought this new section, and they have clarified that for the purpose of computation, they would be deemed as if they are a short term capital asset. The period of holding, section 242A, and all those sections are notwithstanding, and any transfer of such market linked debentures would be computed as if income under the head short-term capital gains. And once they are taxed as short-term capital gains, then there is a higher tax rate, which is 30%. So again, this is an impact from the erstwhile regime where they were only taxed at 10%, and now they would be taxed at 30%, and that too as a short-term capital asset. Now, this is the amendment. Let us see how, one may, depending upon obviously the facts and situation of each case, but there is one loophole which is there, and one can definitely look and try to sort of take benefit of that. So we have section 54F. Okay, section 54F says that where you transfer any asset other than a residential house and you invest the funds out of that capital gains by in a residential house, then you would be given section 54F benefit. So say for us example, let us take a situation where you have this short-term capital gain, okay, market linked debenture gain, and at the same time you invested the money in buying a residential house also, so as to claim section 54F benefit. The question is whether against this section 50AA short-term capital gain, would you be allowed a deduction in section 54F? Apparently, the answer seems to be no. And the reasons are because section 50AA says it would be deemed for the purpose of computation as if it is a transfer of a short-term capital asset. And if you look at section 54F, the reading of the section 54F reads as that where there is a transfer of a asset being other than a residential house and being a long-term capital asset. So apparently it seems that section 54F benefit will not be available. But I think that the benefit will be available. And while I say so, I am relying on a Supreme Court judgment in VS Dempo 347 ITR. In that judgment, there was a very important principle that was laid down. And the principle that was laid down was that if there is a specific provision, specific deeming provision, and section 50AA is a deeming provision, and it has been introduced for a specific purpose, and the specific purpose here is computation, then the meaning of that specific section shall not be extended beyond for the reasons for which it was introduced. So this deeming fiction has been introduced only for the computation purposes. Therefore, for the computation purposes, you may deem this to be my short-term capital asset, but while claiming a deduction under section 54F, I can still take a stand that you look at my period of holding. The period of holding is long time. Therefore, even though for the computation purposes, you may deem it to be a transfer of a short-term capital asset, but for the purpose of section 54F, it will always remain a long-term capital asset. Therefore, section 54F benefit could be claimed. And while I say that, I am relying on a Supreme Court judgment, VS Dempo 347 ITR. So this is again a very important amendment, and this the benefit could be taken, but it is highly dependent upon the facts of each case. Not in every case you will have a section 54F benefit or section 54EC benefit available. So one may have to look the facts and circumstances of each case before looking whether that benefit could be claimed or not. So apart from this, there was another amendment which sort of is an temporary / interim measure wherein the government has clarified through section 47(7)(d) that on the conversion of your physical form of gold into an electronic form, this conversion would not be taxable as gains. So on conversion, there won't be any taxable of gains. Section 47(7)(d) clause has been inserted. Now, one would obviously ponder and would think that, is it really a transfer? The answer is, say for instance, if you have a gold coin, say 25 grams gold coin, and it has letter R written on it, and you exchange it with, your friend the same 25-gram coin and it has a letter J written on it, even on the simple exchange of the same uh, quantity, same weight of the gold coin, but different gold coin, and you replace it or you change it, with another purchaser oblique seller, then even on that change, the taxability get triggers. So here it is more apparent because the physical form will be changed through a virtual form oblique the electronic form. Therefore, it would have been taxable. By way of this exemption, they have clarified that we won't be taxing it right now. Maybe subsequently, when you transfer the electronic gold receipt or the gold virtual coin, then we will tax it. And we would then deem the cost of acquisition, which was in your hands at the time when you actually bought the physical coin. So this is basically an interim measure. Uh, so on interim conversion, there won't be any tax. Another amendment that is proposed is in section 48. And this amendment relates to that, say, for instance, you have claimed certain interest payments on home loan under section 24B, or probably there would be any certain principal repayments that you might have claimed under section 80C. And we have been taking these claims for various SSEs. Then once you have taken these claims, whether under section 24B for the interest payments or under section 80C for the principal repayment, then subsequently when you transfer this asset, then you will have to exclude these costs while calculating your cost of acquisition. So there was a double deduction that was already being claimed by the SSEs, and it was upheld by various tribunals and high courts. And I think Bombay High Court was the lead case in this, wherein they said when the law doesn't restrict you from taking a double benefit, the issue shall be decided in favor of the SSE and that benefit shall flow. But now they have clarified and they have said that no, you cannot double claim it. Once you have taken under section 80C or 24B, then you cannot subsequently claim under by adding the same amount to your cost of acquisition when you transfer these assets. Now I move to a couple of amendments to section 80 IC in relation to startups. There has been a huge buzz that there has been a boost to startups. So I will touch upon a couple of amendments that probably might have a little or more impact depending upon case and circumstances of each company or each entrepreneur, which is a startup. But there is a very big setback for these startups in the sense that if you haven't taken the startup registration, okay, then section 5627B can be a very hard hit. So I'll come to that. But before that, let me touch upon the section 80 IAC, which is for startups, and section 79 related amendment, which is again for the startups. So section 80 IAC benefit was earlier available if you have incorporated your company on or before 1st April 2023. Now this limit has been extended. The sunset clause has been extended. So now you can incorporate a startup till 1st April 2024, and then you can claim Section 80 IAC benefit. Section 80 IAC benefit says that you will be given a claim of entire 100% of your taxable income for 3 consecutive years in the block of 10 years. Further, an amendment has been proposed in Section 79, wherein Section 79 has a condition that if there is a change in shareholding to an extent of more than 51%, then the loss of the erstwhile company before the shareholding change will not be given to the company after the shareholding change. But this Section 79 was amended a couple of years back, wherein for the startups, it was mentioned that for the startups, the condition was made very simple in the sense that if, say, for instance, there was 6 or 7 or 8, whatever number of shareholders which were existing as on date 1, irrespective of whether the shareholding percentage in terms of 51% criteria failed or not. But so far as these number of investors continue to be same in the next year, then Section 79 benefit was allowed. And that was allowed for 7 years. Now they say to align it with Section 80 IAC, what they have proposed it that now you can claim the carry forward and set off of losses for 10 years instead of 7 years. So this is another amendment, small amendment under Section 79 for startups. Now let me look at Section 56(2)(7)(b). Again, a very significant amendment, and I will be stressing it on it a bit more rather than other amendments, because to my understanding, it has again very huge impact. So Section 56(2)(7)(b) basically is a section which is applicable on a company which issue shares to shareholders. And the section says that the amount that you receive, okay, should not be more than the fair market value of the shares that you have issued. So you will have to benchmark your issue price with the fair market value, and the fair market value has been prescribed in Rule 11 UA, wherein the DCF mechanism has been referred to merchant bankers, and a fair market value has been worked out. Now they say that this provision, which was earlier available only for the resident investors investing in an Indian company, will now be applicable even for the non-resident investors investing in the Indian company. So this condition was not there. Only the resident investors were earlier included. Now even the non-resident investors are included. So now this has impact on the newly incorporated companies. So there are companies, and I have seen many examples, which are new, but which do not technically fall in the definition of startup, for the reason that either their turnover might have crossed rupees 100 crore, or they might have not availed the startup benefit scheme for various reasons. But they are in a sense a newly incubated entity or a startup, by their soul and by their spirit, but not technically in terms of the startup definition. So those companies will be hard hit. Why so? Because Section 56(2)(7)(b) has provisos, and that provisos says that if you are a startup, then Section 56(2)(7)(b) will not apply to you. But if you are not a startup, then this section will apply to you. Now, there is another angle to it. So one thing is clear, that for non-resident investors, Section 56(2)(7)(b) will be triggered. And I'm taking a situation where I'm not a startup. Okay. So Section 56(2)(7)(b) would say me that I will have to justify my issue price with the fair market value. At the same time, I have a transfer pricing provision also now triggering in, because Section 92 under Chapter 10, which is a transfer pricing chapter, it says that any income arising out of the international transaction shall be subject to the arm's length testing. Now, if you look at the definition of income under Section 224, Section 56(2)(7)(b) related income is covered there. That being so, if my holding company, which is a non-resident holding company, invest funds into my resident subsidiary Indian company, additional funds, right issue, whatever it could be, bonus issue, then whether Section 92 and the entire transfer pricing provision will also be triggered besides 56(2)(7)(b? That's a question. Okay. So now we have two anti-abusive provision. One is 56(2)(7)(b, and the other is the transfer pricing provisions. And they both are anti-abusive provision. They both are deeming provision. They both apply in different scenarios. The question is whether in this situation where you are having an income coming by way of an investment in an Indian company, whether the transfer pricing provision will apply or 56(2)(7)(b) will apply. The test is very, very difficult. The one of the test is that you will have to see that which of these sections is more specific. Okay. Now, if you look at which of these sections is more specific, then again, you are into problem, because if you look at transfer pricing provision, it applies to all the incomes, but it only applies to a situation where there is a non-resident investment coming to a resident entity. Now, if you look at section 5627B, it is also very specific, but it is generic in the sense it will apply to even non-resident investors as well as resident investors, but it is specific in the sense that it will only apply on issue of shares, whereas 92 will apply on the entire income. Now, so there are certain unique areas. Okay, there are certain common. One element is falling there, and one element is falling here. In this scenario, you cannot determine which section is more specific. Therefore, to the best of my understanding, both the provision, unless there is a clarification by the government, both these provisions will apply. Apart from the benchmarking through a fair market valuation, one will have to report this transaction in Form 3CB, will have to get it benchmarked also. And what method you will use, whether SIX method will apply or not, all these are open questions which may be subsequently discussed by way of a separate webinar. It's a very detailed sort of analysis. So, but right now I'm highlighting that, there is this problem which persists. Okay. And now, ending my discussion on 5627B, let me come to the amendment that was introduced for cooperative societies. So there is another new section, which is section 115 BAE, which is a concessional tax regime, which has been introduced for new manufacturing cooperative society set up on or after 1st of April 2023. So it is similar, like 115 BAA and 15 BAB, which is there for manufacturing and service sector, which was introduced 2-3 years back. It's a similar provision, but this is for cooperative societies. Apart from this, there are 2-3 small amendments in the transfer pricing chapter as well, wherein uh, once you get a notice under section 92D, read with rule 10D, in the course of your TP proceedings, then you are supposed to, under the earlier law, you are supposed to submit the detailed documentation, which is nothing your TP, but your TP study and other reports within 30 days of the time, from the time given in the notice. And this date of 30 days can be further extended by 30 days, depending upon the facts and circumstances of the case and upon the request being made by the SSC before the transfer pricing officer. So now this timeline has been reduced to only 10 days, which is further extendable by 30 days. So if you see, there is a very paradigm shift from 30 days timeline earlier given. Now the timeline is 10 days. So once you get a TP notice, you will have to be ready with your TP study, and you will have to not just be ready with it, you will have to submit in just 10 days time, and it will have Saturdays and Sundays as well. So this way, I wanted to just highlight that by the time you file your Form 3CBs, which is 31st of October, generally, one has to be ready with the TP documentation also, because you never know when you might get a notice. And at that point of time, the time would be really less for you to prepare the final draft of the TP study. So one has to be ready with the TP study at the time of filing of Form 3CB itself. That apart, there is another amendment under section 92BA, which is a specified domestic transaction. It has also been amended to say that for the entities, for the cooperative societies which are falling and claiming the deduction, the benefit under this regime under section 115 BAE. So if they transact with any entity which is their closely connected person, then the transaction, even though these entities would be Indian entities, one would be the cooperative society claiming benefit under section 115 BA. The other would be any closely connected person of that cooperative society in India only. Then if there is any transaction between them, section 92 BA, which is a specific domestic transaction, will apply to them. This obviously is subject to the threshold which is applicable for specified domestic transaction, and which is for the time being is 20 crores. Uh, the next judgment or amendment is in relation to section 94B, Section 94B, mind you, my friends, is relating to the limitation which is being imposed, where you pay interest to your foreign AE, then the deduction of this interest is subject to 30% of your EBITDA or the actual amount of interest, whichever is lower. Now, from the ambit of Section 94B, the banking companies were earlier removed. NBFCs were making requests because they were making their case before the ministry that we also have the same business as the banking businesses. Therefore, we should also be excluding out of the ambit of Section 94B. So, by way of this amendment, NBFCs have been excluded out of Section 94B. And this again is in line with the BEPS Action 4 plan. So these were the limited amendments that were made in the transfer pricing chapter. Uh, Another amendment that I find interesting is in relation to the revamping or sort of reintroduction of a new appeal forum, which is nothing but which was there some 20-25 years back also. I think I was told it was discontinued in the year 2000. So there was a mechanism earlier wherein an appeal before the Joint Commissioner of Income Tax appeals oblique additional commissioner of income tax appeals could have been filed. From 2000 onwards, that were discontinued, and the only mechanism which was available was Section 246A, wherein the appeal could have only been filed before the CIT appeals. CIT appeals is a higher rank than a joint commissioner of income tax appeals or additional commissioner of income tax appeals. So CIT appeals is a higher rank, and that was available till now. But now the legislature has understood, and probably the administration would have highlighted them, that there are many pending cases and the CIT appeals has been overburdened. So therefore, to address this difficulty, the new forum has been announced, and which would be called as Joint Commissioner oblique Additional Commissioner Appeals. It would deal with small amount of disputed amounts, and what orders you can appeal are already been prescribed, and there are certain appeals which are pending before CIT appeals. The department will decide as to how these cases can be shifted from the existing CIT appeals to Joint Commissioner appeals. One thing which has been missing in this aspect is with the new regime which has been introduced, which is the National Faceless Appeal Center, the CIT appeals was subsumed by National Faceless Appeal Center. How this Joint Commissioner of Income Tax Appeals will work, whether it will also work in a faceless manner or will it work in a normal face-to-face manner, which was earlier, that aspect is missing in this bill. So I cannot comment as of now, but the way it reads, I think it would be a face-to-face hearing. So another amendment relating to further procedures before ITAT is in context of the cross objections that could have been filed before ITAT. So once you file an appeal before ITAT, the respondent is given a chance to file cross objections against that appeal. Now, if you look at Section 253, subclause 4, it says that only the orders of CIT appeals which are going to ITAT, only against those orders one can file cross objections. So now Section 253(4) has been amended to say that for other orders also, which are not passed by CIT appeals, but still they are going to ITAT, the cross objections can be filed by the respondent. And one such big example of the situation is a appeal filed on the DRP order directly maintainable before ITAT. So now for the DRP orders also, which appeal against which lies before ITAT, the cross objections can be filed by the respondent before the ITAT. So this again is an amendment which fills that gap. Another amendment, again a very important one, is in relation to the Section 115 BJ, which is introduced for online gaming, and it's a new provision which says that it will apply from 1st of July, and the tax shall be payable on the net winnings from online gaming. and there are certain terms like what would be the definition of online gaming that has been prescribed in the act itself, which says that the game which has been defined to mean a game is offered on the internet and is accessible by user through a computer resource. And a new TDS section is also being introduced, which is section 194BA, which would, and there is a mechanism which is being prescribed as to how you will have to deduct TDS, on this net winnings. And the rates are rates in force, and the applicable point will be at the time when the money is being withdrawn from the account of the person who has made those gains. Then there were a couple of amendments in withholding provisions, wherein in absence of a PAN, if you withdraw, the amount from the PF fund, then there was a maximum marginal rate that was levied. Now they have said that in absence of a PAN, even then the 20% maximum rate could be levied. So apart from this, there was certain rationalization, like there is a further amendment to section 196A, wherein they say that even though the rate prescribed under section 196A is 20%, but that rate is always subject to the DTA benefit. And say, for instance, if a DTA benefit is lower than 20%, then the lower rate will apply. Apart from this, yes, there is another amendment which is in relation to section 206AB, which provides that a special provision for a higher TDS was applicable for the non-filers of income tax. So in this non-filers category, there were certain non-residents also which were filling. So the government has clarified that these non-residents who do not have a PE shall be excluded. So even if they don't file their return in India, and rightly so, not everyone would be obliged to file return in India unless you have a PE or you have any other income for which one may be required to file tax return in India. You cannot force them just for the purpose of ensuring that a lower TDS rate is deducted. So that aspect has been clarified by way of this amendment. So, ladies and gentlemen, with this, I would like to conclude my presentation for the day. Thank you for joining me.
Thank you so much, sir, for such an insightful session. I think all the changes which has come in direct taxation are obviously included in the this presentation, and I think all our audience have understood the changes which were so nicely explained by sir. Thank you so much, sir. And now I would request if anybody is having any questions, our audience, if anybody is having any questions on direct or indirect taxation, you can let us know in the comment section. Or you can raise your hands also. So I think there was one question which is there in the chat box. How can we calculate which income tax option is beneficial for an individual? Sir?
It largely depends upon, fact specific situation, whether you would have, various benefits like HRA, ATC, all these benefits available, to what quantum they are available, section 80D benefit, whether it is available or not. So it's a very fact specific answer. It would depend upon case to case, but yes, there would be situations where you would find an old regime more beneficial than the new regime. So it is not that the new regime will by default will be beneficial to you. It's a fact specific scenario.
Okay. So let us conclude the session because I think there are no more queries. So I would like to thank all our speakers, CA Rajat sir, CA Gitika ma'am, and Tushar sir and Rajiv sir for explaining so nicely on the changes which have come in this budget. Thank you so much, and you can also check our the number and details given on the screen for further information regarding the webinars and the upcoming changes. So thank you so much, and we'll be seeing you in the next webinar shortly. Thank you for joining us. Have a good day.
Thank you. Thank you, everyone.
Thank you.